Testing, testing. Okay, good afternoon, everyone. Welcome to our lunchtime US Market Outlook webinar. My name is Roy Yap, and I'm from the Global Markets Desk. On behalf of Global Markets and my colleagues from Phillip Research, we would like to extend a warm welcome to everybody to the webinar today. With the talk of tapering of the massive quantitative easing program and the impending change of the chairmanship of the Federal Reserve, where is the US stock market headed, and which US companies will be in the position to take advantage of the situation? We are glad to have with us today our Phillip Research colleagues, Kenneth and Yong Kai, to give us an overview of the current US market, as well as a look at some stocks that are good investments in the current environment. A short introduction of our presenters today. Mr. Kenneth Koh is the Markets and Equities Analyst of Phillip Securities Research. He has 5 years experience of trading Singapore and US equities. Kenneth graduated with a Masters of Industrial Engineering from Cornell University. Mr. Wong Yong Kai is the US Equities Analyst of Phillip's Securities Research. He has a background in fundamental analysis and has 8 years of experience investing primarily in the US market. Yong Kai graduated with a Bachelor of Accountancy from Nanyang Technological University. So without further ado, I shall invite Kenneth to start off our presentation today.
Okay, hi everyone. Good afternoon. I'm Kenneth. I'll be talking about the market analysis for today, specifically the US market. Okay, so let's start. Oh, okay. All right. So here's a closer look. So today we're going to talk about the economic snapshot, we'll be followed by the S&P 500 analysis itself, and then we're going to look at the intermarket analysis and sector rotation to delve deeper and get a better sense of what's really going on with the markets in the US. Okay, so we know what's on the news, right? Since last week, there's been a correction, a sell down from a consolidation, and due to negative, disappointing results by some retailers last week. That was one of the triggers. We know that Walmart and Macy's had disappointing results and readjusted their guidance for the year. So this caused, I guess, some fear in the retail market, and that caused a sell down. But note that actually 2 weeks ago, we gave a guidance that we thought a short-term cycle was imminent, and that the consolidation from last week was already weak, and that it was probably going to correct in the first place. So this is not unexpected for us. Now, all right, we see here that the Asian markets. Okay, so Asian markets have sold off in the short term based on Fed tapering fears as well as poor results from certain retailers. But we want to reiterate that global data itself is still generally supportive of an equity bull run. It is not all doom and gloom. Second half, global GDP growth is expected to be stronger than the first half. Okay, but of course, caution is required in the short term because we are in the midst of a correction, and we believe the correction still has legs. Okay, so the S&P 500, S&P 500 longer term, the bull is still intact in our opinion, but we are in a shorter term correction mode. So the S&P dropped by about 3% since last week. Okay, but we just want to note that cyclicals, materials, and industrials have outperformed and due for pullback. It was due for pullback. However, breadth and cycle indicators point to further weakness, so probability is of a continued sell down rather than a bounce from these levels. We believe the correction could take maybe 2 to 4 weeks and may head back to June lows, but we believe a correction to these levels would be a good buying opportunity barring any extraordinary news. Okay, here's the economic snapshot. I just want to raise 3 charts to your attention. Okay, the chart on the bottom right is actually global PMIs. As you can see, this is the global PMIs 3-month smooth average quarter on quarter. So if you look at the PMIs, whether manufacturing or service, you see that in general we are still above 50 and we are still in positive growth territory. We are actually quite a ways from negative growth. So this is actually, so global PMIs are actually positive. For the US leading indicators, we look at top left, US new orders. These are durables for new orders, X transport and X defense because they are volatile. And you'll notice there's still a positive correlation starting from June 10th. From June 10th, there's positive correlation in terms of positive growth. For housing starts, we also note that even though most recent news have disappointed, but in general, if you look at the average, right, we are still trending upwards as follows and in positive growth territory. So though these numbers are not fantastic, but at the same time, it gives us economic basis to say that the bull run or business cycle is still intact, although we have seen the first signs of weakness. Okay, here is the S&P chart itself on a weekly basis for the last 4 years. The key thing is this: even with the recent sell-off, and we're now at 1646, we are still in this up channel. We are still in this up channel, and as long as you're in this up channel, the trend is still up. So we do recognize short-term as weak. Now notice on the daily chart, there has been weakness prior to this sell down. We guided a few weeks ago that the RSI and the PPO were diverging, and that hinted of impending cycle down. On the daily chart, as we take a closer zoom in, you'll notice that the PPO had already cycled, crossed and cycled down since the first week of August. That coincided with our week consolidation. When you look in this consolidation, we guided last week that there was probably going to be a breakdown because of weakness in the McLaren oscillator. So this sell down actually did not surprise us, but it has happened. Now the question in everyone's mind is how deep the sell down will be, and is this the start of a bear market? Okay, first of all, the price has cycled down. So since it has cycled down, immediate targets were, I used the word if because I prepared this slide on Thursday. Oops. The immediate downside targets are 1650, which we've actually hit already. It was the first target to get hit and have a slight bounce here, followed by 1625. Okay, 1625 is this level over here. That's the next target, and followed by 1550 to 1575, which is this blue zone support line, which we think this is the most likely target of this sell down. Okay, a correction to this level would be considered a the time essentially when you should be shorting bonds, going long on stocks and commodities. Okay, and okay, why do we believe we're here? If you look at long-term charts of bonds, so the top chart is the US Treasuries, 10-year Treasury prices, not yields. Here's the S&P index, and here's GSI futures, which is a proxy to industrial commodities. You'll see a few patterns. One, bonds have started its first sign of a major weakness or sell down since 2011. So here, the question now is, and plus the fact that the Fed has already talked about tapering, this leads us to think that although now we are consolidating here, we are biased towards the downside. It will continue going down. So bonds have started to come down. Stocks, we've been in an uptrend for quite a while, and we still believe the uptrend is intact. Commodities, we believe that this is not a long downtrend, rather it's a consolidation from 2009. We're consolidating to eventually break out. So we believe that commodities will have some legs to go up. Okay, so bonds are starting to come down, stocks have been up, and commodities look like it's got legs to go up. So based on these three things, you'll notice that that's what happens in phase 4. In phase 4, bonds is when bonds start to sell down. Okay, commodities have started going up, but it still has legs to go up. And of course stocks, and over here will be a March 2009 stock market bottom. So based on this chart, commodities and stocks actually still have some legs to go up before it is over. So that's why we believe that the bull market is still on, but we have to wait out this correction period, which could last for a couple of weeks. Okay, now based on where we are on the business cycle, these are certain sectors that are supposed to do well during this phase. Okay, so if you are correct and if you are on the correct side of the business cycle, you should have some sort of information that corroborates that these are the sectors that are supposed to do well. Now, of course, we note that since 2009 and there's massive liquidity and that the business cycle was compressed as well as become non-ideal. But at the same time, we still look for these things just to understand where we are in the business cycle. Okay, so notice that over here, industrials, materials, and energy are supposed to start to do well or take leadership. So here we have sector glances. Don't be overwhelmed by these charts. Essentially, these charts are the 9 sectors of the S&P. So as you can see, top left is cyclicals, followed by technology and industrials. Okay, the key thing is this. We know that all these sectors have been selling off. That's not the issue. What we want to look at is the sub-chart, which is at the bottom of it. Each sub-chart is the relative strength of that sector versus the S&P. So for example, this chart over here, this is the XLY, which is the cyclical sector versus S&P pricing. So it measures the relative strength of which is outperforming or underperforming the S&P itself. So the key thing is that even though we're having a sell-off now, by one glance at these sectors, you realize that 4 of the offensive sectors, or 3 of them, still have longer-term relative strength. You'll notice that cyclicals are still outperforming as compared to, let's say, consumer staples, which is still underperforming even during the sell-off. As you can see, the staples have sold off here, and this sell-off is actually not as bad. Okay, so essentially, based on the relative strength, we see that cyclicals, industrials are still doing relatively strong. So this indicates that more of where we are on the business cycle. Okay, hence we believe in the future that we can, there's still case for further upside for stocks after this correction. Notice that for energy, right in the middle here, the relative strength has never really had leadership, which is coherent with what our thesis is that we are not at the top. Because at the top of the stock market cycle, usually energy is what takes over leadership as commodity prices become, it's not happening yet, but it's slowly turning. Okay, to corroborate our thesis, easier look at how the sectors are performing. So this is called a relative rotation map, and very quickly, it just means this. We have 2 axes. This measures the performance and movement of the sectors. So what you see in the middle with trails are the different sector movements in terms of their pricing and momentum. The bottom axis is the relative strength ratio. Okay, so if your sector is on the right-hand side, it means for the past 12 weeks, your market performance have been outperforming the S&P. If you're on the left-hand side, your price performance has been underperforming the S&P. On the y-axis, it's the relative strength of the RS ratio. It's the rate of change. So if you're on the top, it means your relative strength has been increasing in strength. And if you're at the bottom, it means your relative strength has been decreasing. So the point of it here is you can see that where you are right now, the industrials, consumer discretionaries have been the strongest, and soon to get to that point is materials, energy, and infotech. Okay, so I just put a highlight here that you see that finance and consumer discretionary have been strong leaders, and on major pullbacks, these will probably become good buying opportunities. So hence, later on, we are going to talk about some stocks in the finance and computer sectors. Okay, and later on in the business cycle, industrials and materials and energy will be on the improvement and maybe next to lead, maybe. Okay, we're not sure exactly when though. Okay, so the conclusion for the US market outlook is as follows. So the global markets look generally weak on the short term. Okay, however, it is supportive of a bull run in the longer term. Okay, US data is mixed but more positive than negative. Okay, now the S&P longer term bull we believe is still intact, but we are in correction mode right now. Okay, cyclicals, materials, industrials have outperformed, and it was due for pullback already anyway. Okay, but breadth and cycle indicators point to further weakness. Okay, the correction may take 2 to 4 weeks, and we may be headed to June lows. We believe a correction to these levels would be a buying opportunity. So a suggestion is that for consideration, for some key sectors to look at when the correction is over will be cyclicals, finance, industrials, and energy. Okay, so now I shall invite my analyst, my colleague Yong Kai, and he will talk about two stocks which are within these sectors, the finance as well as the consumer discretionary sector, to combine with what we talked about in our sector analysis. Okay.
Hi, hello. This is Yong Kai here. I'm the US analyst. So today I'll be covering two stocks. The first one is the Genworth Financial. It's actually so the share price as of last Friday was $12.60, which is on the higher end of the 52-week high. Market cap is $6 billion and is a component of S&P 500. Okay, so what this company does, right, is actually a insurance holding company. Yeah, this is a very quick snapshot of what the merits. As you can see that there is a lot of positives going for it, and market cap being $6 billion versus the GAAP book value of $14 billion makes it a deep value play. Okay, and I'll quickly go through the sum of parts first before I really talk about the components. So the fair value we have valued at $17, whereas the market price is $12.60. As of yesterday night, it was actually $12, so the calculated upside now is higher 40%. Okay, this is an insurance holding company, so you have different components of US mortgage insurance, your Canada mortgage insurance, Australia. As the other key component is actually the US life insurance as well. So all in all, we're valued at $17 fair value, and the rating is a trading buy. Okay, so a quick background. It's formerly owned by General Electric, IPO in 2004 to raise capital for GE. GE actually monetized its shares at $19.50 to $34.66 per share. So today it's actually around $12, which is substantially lower than where GE sold out at. Management is very proactive in capital allocation. Yes, actually raised about $3 billion from all these actions over the past few years. So right now we're going to talk about the first insurance component, which is mortgage insurance. What it does, actually, US lenders, they require 20% down payment of a home's purchase price, similar to what Singapore does today. The only difference is that if your mortgage costs more than, you are borrowing more than 80% of the value of the mortgage, of the house, you need a mortgage insurance. At one point, all insurers are actually close to breaching the regulatory requirement, but right now, the remaining players are compliant. The remaining players are actually AIG, Radian, MGIC, and Genworth. competitors that collapse or discontinue their mortgage insurance is Track Guarantee, PMI, and Old Public. So one positive that we have it going forward is that losses from older policies are running off, whereas the new policies are highly profitable. More than 1/3 of Genworth's in-force policies are written after 2008. So we do a quick comparison. We see that right now only AIG and Genworth are profitable year to date. Genworth is actually a sound proxy to participate in US housing recovery. As you see from the above table, this delinquency ratio is actually the lowest among the three. Although it's writing lower new insurance, but that's really a non-issue because some of the competitors are underpricing its policies like Radiant. So if Genworth, if these components, the US mortgage insurance, is properly traded, it will be at the lower end of the calculated EV over risk in force, and you value it at $4.68. If you had used a PB instead, we're actually looking at $6 to $8, which is a higher valuation, but to be conservative, we are not going to use that. The other one is international mortgage insurance. So the split between Canada and Australia. Canada, as you can see in the financials, is actually doing pretty well up to the first half of this year. It has been giving out plenty of dividends, buybacks, and book value has been increased as well. Loss ratio is actually dropping over the years. Now it's 28%, which is lowest among the past 5 years. Some background is that it entered the market in 1995. Currently it's number 2 market share. Number 1 is the government owns. Number 3 is actually very tiny. The shareholders' equity is $118 million versus roughly $3 billion for this Genworth. So right now it insures $150 billion of the 300 limits on private insurers, which means there is still plenty of room to grow. Book value has increased 40% over the last 4 years and is immensely profitable. So since the July 2009 IPO, this 57.4% owns Genworth Canada has returned $1 billion to shareholders. Currently its market cap is $5.75 billion. Dividend yield is 4.5% and PB is 0.92 times. Genworth, its share of dividends and buybacks, plus the net IPO proceeds is $1.35 billion. Yet currently its stake is only valued at $1.53 billion, yeah, which is just marginally higher than what is collected over the past 4 years. On the market price, this will be worth $3.07 per share to Genworth, the holding company. Australia, it entered the market in 1997 by acquiring the government-owned insurer. It's number one in 2012. Written premiums is $493 million. Number 2 is has 2/3 of it, which is roughly around $324 million. The Sydney Morning Herald, which is one of the leading newspapers in Australia, actually stated that these two holds a combined 75% market share. So even though you see that the book value has dropped from $2.3 billion in December 12 to $1.9 billion in the half year 2013, but that's really because of the 12% devaluation of Australian dollars versus USD in the second quarter, and also there's a dividend payment to holding company. So what is plans for this? Australia MIG planned an IPO last year, but it stopped because of the Queensland flooding led to underwriting losses. It's on track to relaunch IPO next quarter or after if the IPO activity picks up. At the same time, the RBA has actually lowered rates from 4.75% to 2.5%. So since a lot of the Australian mortgages are floating rate, 90% of them are floating rates, so they'll instantly enjoy lower installments. Gap book value is $1.9 billion, which should be higher if not for the devaluation. Even then, even factoring the devaluation, the second quarter net operating income is up 20% sequentially. So if we assume that Australia MI can be floated at similar valuations as its publicly traded peer, this segment will be worth another $3.51. Okay, intentional protection is actually a very small component, so I won't go very in-depth into it. But just know that looking at the statutory capital of $708 million, 1 times will be worth $1.40. Lastly, the US life insurance is very critical because it's the biggest book value. The profits are really unpredictable because of many variables. If more people pass away this year, you have more losses. If you have your adjustments to loss reserves, you might actually end up with a gain. There's also capital management initiatives, such as one in 2012 that freed up $340 million capital but led to short-term gap losses. Fixed annuity is essentially a spread business. So if in today's lower interest rate environment, it's actually getting harder to get a good return. Lastly, what we want to look at is the risk-based capital ratio, which has reached 445%, above the internal goal of 400%. They have also paid $100 million dividend to holding company second quarter 2013. So we look at the trend, the risk-based capital actually increased constantly over the years to an all-time high. Long-term care is slightly more problematic. There are no bad assets but just bad pricing, as quoted by Howard Marks. The same applies to insurance. Many of these competitors have exited long-term care because of inaccurate actual assumptions, and as well as a low interest rate environment. As a result, General, which is the biggest long-term care player now, is 24% market share of in-force policies. Currently, is in the midst of seeking regulatory approval for $200 to $300 million premium rate increase, and it secured roughly half of that. So, how we value it? We look at the GAAP book value of $10 billion, of which 2.7 is actually due to unrealized gains and gains from interest rate hedges. Life insurance really needs to match assets and cash flow to liabilities, which is our future claims. So AOCI cannot be considered part of the book value because the benefits will only realized over the longer term. As a result, we obtained a residual book value of $7.2 billion, and there's no recourse debt. So we look at comparables: Lincoln Financial, Protective Life, which is a disability insurer. We use the lowest end, which is 0.96 times book value, that's AOCI. I will apply another 20% haircut to reflect the uncertainties. This component is still worth $11.23. Remember, General share price now is actually $12. So this life insurance itself is worth almost entirely the entire market cap right now. Corporate runoff is actually where the debt is housed. So most debt are actually issued at the holding company level, distinct from the various subsidiaries. US life insurance does have funding obligations, but they are non-recourse and securitized by policies. So all in all, the negative equity is $2.65 per share. So lastly, we'll look at the valuations. If we sum all of them up, as previously mentioned, all these life insurance components up, we get $21. And we apply another 20% holding company discounts, we arrive at $17. Given market price $12.60, and today's market price is around $12, we are looking at around 40% upside, and we rate it a trading buy over the 12-month periods. In conclusion, given this current share price, actually it's trading at a very steep discount regardless which valuation you want to use, whether it's the book value of $29.76, whether you exclude the unrealized gains and interest rate hedges, you still get $23. Some of the parts will be $21, and our target price is $17. The management is very competent. It's raised $3 billion from non-core asset sales. The US outlook is positive, as we are previously described by my colleague Kenneth, and it's a very low leverage ratio and it has excess capital. So we really think that this General Financial, which is a S&P 500 component, $6 billion market cap, is a very compelling buy at today's prices. Next, I want to talk about Iconic's brand. So Iconic's brand, just a quick look at the share price, is $32, which is again on the higher end of the 52-week range. Fully diluted shares is actually 73 million versus the outstanding shares of 54 million, because they have two tranches of convertible bonds that we assume will be exercised, will be converted under our scenario. So market cap is slightly smaller, $2.37 billion. So just some background. Iconic's brand group actually focuses solely on the marketing, advertising, and licensing of its consumer brands, chalking up a total of $13 billion global annual retail sales. You all might not be aware of this company, but it's actually ranked number 2 global licensor, only after Disney, and ahead of more well-known brands such as Calvin Klein, Mattel, and Warner Brothers. So because it only licenses its brands, it has no operational nor inventory risk. It doesn't need to bother about sales, about sourcing, manufacturing, warehousing. There's little need for working capital or expenditures. So some of the brands that it holds are like OP, Peanuts, Echo, Lee Cooper, London Fog as well, which is a trench coat. Two of the licenses that it deals with is one is direct to retail, exclusively to only one national retailer for a broad range of products. These 4 retailers represent 30% of financial 12 revenue. The other kind is the traditional wholesale. Yeah, right now they only disclose that Li & Fung contributes 6% of the last year's revenue. So some of the merits, you have very high customer demands, you are earning high private label like margins. So let's say you have the slippers. Will you want to pay $12 for a private label Walmart slipper, or will you pay $13 for OP slipper? I think the answer is very clear. Calculations suggest that royalties average only 3% of gross revenue. So in the last 5 years, Iconics actually successfully branded $7 billion of annual sales. The founder and CEO actually gave us another 2 anecdotes. 2 brands are actually in the 12th and 13th year in the 2 retailers. They are addicted to the large market share because they source directly. And because these brands are exclusive, you don't have to worry about price comparison. You don't have to worry about going to Amazon and finding a cheaper alternative. So they do have non-renewals, but all the $1 billion plus brands have been renewed successfully every year since they started this model. They have recurring high margin revenues as well. Contractually guaranteed minimums are $600 plus million as of the start of this year. Last year's revenue is $350 million, yet they only employed 148 employees. So this works out to a very impressive $2.5 million sales per employee. Net margins are 35% and EBITDA margin are 64%. That's because it has no inventory risk. You have no cost of sales, so its gross margin is actually 100% versus, say, Macy's, for example, which is 40%. Capital allocation is very disciplined as well. The management weighs every acquisition against buybacks. It actually repurchased 18% of outstanding shares since the start of this year for an average price of $25, which is very smart because you look at the current market price, it's actually $32, $33. They have another program which authorized, which can repurchase another 14% of outstanding shares. Acquisition criteria is very established. They look at brands generally their portfolio is more than 50 years old. They also want it to be capable in multiple product categories so that they can have product line extension. They want the consumers to recognize 70 to 80% of the consumers to recognize it, and they want 65% purchase price to be guaranteed. So on average, they pay about 5 times revenue, which works out to roughly 7.5 times, 8 times EBITDA, which is really undemanding. They also look at great partners such as Walmart and Li & Fung. So all in all, they have spent about $1.9 billion to purchase all these brands since 2005, and they expect to earn back in revenue by end of 2013. If you recall, at the start of our slides, market cap is roughly $2.3 billion. So actually, they are just buying in at the total amount they spent on the brands over the past 8 years, and assume that they haven't done anything to the brands at all. In the last 12 months, they actually spent another $300 plus million on 3 brands that will earn 70% EBITDA, which works out to around 7.5 times adjusted EBITDA multiple. Another overlooked fact that most houses won't mention is that they do get a lot of tax benefits from a 15-year amortization of intangible assets, but they don't incur any gap amortization because of the indefinite useful life of the trademarks. Growth strategy: international revenue is up to 33% from 6% in 2009. They have 50-50 JVs in China, India, Canada, Europe, and Latin America, all of which are actually recorded under the equity method of accounting. What this means is that any revenue growth actually doesn't get reflected under the revenue, but yet only under the equity line. This also means that wherever they enter into a JV, the revenue from the territory is deconsolidated immediately. On the other hand, they do receive upfront cash payment for this JV, and in return they get vested local partners. So some of the local partners that they are in JV with are Silas Cho and family, which is behind the rejuvenation and sale of Tommy Hilfiger, as well as Michael Kors, which recently IPO'd in US last year. Reliance Industries, which is the largest private sector employer in India, as well as Phillip Group, which operates over 150 duty-free stores in Americas and distribute luxury brands. So for the remaining 2013, they are possibly looking at 2 more JVs. With just a quick look at the 2 of the JVs, how their performance are like. Latin America, the revenue is up 56% year over year, as it's increased from $1.7 million before JV formation to $10 million in just 5 years. Iconics in China, they own equity ownerships in 11 companies, which they realized $6 million pre-tax gains when they monetized part of the shareholdings in 2011. They project 700 plus stores. They project presence in 700 plus stores and shops by the end of 2013, up from 500 today. The best of all is that the new JVs have put in calls that will enable Iconics to repurchase this 50% interest and consolidate in international results, because they feel that they are not being given enough credits in the markets for this international exposure. Okay, so just a quick look. Say image being over before you have limited floor space, no brand signage, weak brand packaging. After you actually get something which is very prominent, and you get a very prime space because retailers get exclusive exclusive brands which they market it almost as their own, so they do give it priority. Your product line extensions, from 2008 you only have like maybe about 7 products, to 2010 you have over 20 products. You have your retail store penetration, you bring more presence. From 2005 you have 732 stores. In 2008 to 2010 you have 1,067 stores. So in just over about 3 to 5 years you have increased your store presence by 50% without any of their working capital. Lastly, they enjoy very low cost financing. So they actually set up a Securities $1.1 billion facility, of which they've drawn down $875 million. Even though interest rate for the past year has been all-time low, but it's really impressive that they can still get it at 4.268%. The interest rate will reset in 2020, which is earlier than the legal maturity in 2043. Meanwhile, they are expected to pay back $60+ million of principal every year, which will help to keep the debt in check. Another thing to note is that the credit market actually gives it very high status. So it's able to issue these convertible notes at 53% and 65% premium to the current market price back then. Okay, so we'll just gloss through the financials. Revenue has went up 28% CAGR from 2006 to 2012. Marginal dip is actually because of the transition of a brand from Bath & Beyond to JCPenney, and as we all know, JCPenney isn't doing that well. The only acquisition in 2012 is also completed only in December, so they only contributed at most 1 month results to 2012. Revenue is forecasted to increase 22% year over year, driven by low single-digit organic growth and completed acquisitions. On the other hand, free cash flow has also increased 26% CAGR over year. It's actually higher than net income because of substantial deferred income taxes, which is $20 million, and you have the amortization of convertible notes discount, which is another $20 million. So this free cash flow growth is slightly lesser than the revenue growth because of different cost structures. For example, peanuts, it generates 30% EBITDA margin compared to the 60 to 70% average. So we quickly look at the valuation. We use a DCF. We use the mid-range of the projected free cash flow provided by the management, and we deduct $12 million stock-based compensation to arrive at $195 million. Current WACC is 7.44%, but we assume a higher 7.78% because of a higher 10-year treasury yields of 4%. So finally, we assume 3% terminal growth G, which consists of 2 parts. One is the 2% that revenue can grow as fast as inflation, 2% domestic, as well as the international growth, which is 5%. Once again, let's recall that Latin America revenue increased 56% year over year, and they are all starting off a low base. So we think that 5% international growth is actually very conservative. If all these assumptions are, with all these assumptions, we work out that Iconics will be worth $3.15 billion market cap. Even if it doesn't convert its convertible bonds, or if the G is lower and higher, we have also provided a table for you to look through and understand. So finally, all in all, we work out the fair value to be $43. Market price as of today is around $33. So we still have a calculated upside of 30%, and we did a trading buy over the next 12 months. So some of the conclusion, this is really fairly unknown. It's number 2 global licensor, $13 billion sales. but yet nobody knows about its presence. No inventory or operational risk. It's very high customer demands because they get a brand, their private label products, and sell it for a significant higher price, and yet still earn very high margins. Revenues, there's $600+ million, which is contractually guaranteed, and EBITDA margins are 64%. Capital allocation is very disciplined. They weigh every acquisition against buyback. Should I buy Umbro, or should I buy back iconic stock? Should I buy Lee Cooper, or should I buy iconic stock? Yeah. So they've actually repurchased nearly 12 million shares as of the start of this year. Acquisition criteria is pretty stringent. They aim for 65% purchase price and guaranteed minimums, 5 times acquisition multiple, and they get to enjoy a tax benefits by amortizing it over 15 years. But yet, they have no gap expense. The multi-pronged growth strategy, you can make over the brand, extend the product line, improve the retail store penetration. You also have the international revenue that has grown from 6% to 33% by end 2013. Part of it is organic, part of it is brand acquisition. It's also driven by 50-50 JVs with Sedas Cho, Reliance Industry, among others. Okay, so we have come to the end of the presentation. We'd like to take this time to open the floor to any questions that you may have. Okay, so we have a question. Okay, the audience asked that right now we are in the correction phase for the US markets, and the longer term, the outlook is bullish. How long will the correction phase be, and when will the correction phase end? I'll direct this question to my colleague, Kenneth.
Okay, mic check. Okay, hi. Okay, so the question of the day is simple. Is the correction for the U.S. market? Is it a short-term correction, or this could be a start of a bear market? And if it is a short-term correction, how long could it last? I've addressed a little bit of this earlier, but essentially, if I want to make a educated guess, and also based on the history of the cycles of the last 2 years, looking at different breadth indicators as well as relative strength indicators, right? It would seem highly probable that the price might get to this level, but it might take probably 2 to 4 weeks, 2 to 5 weeks to get there. So that's all I can say for now. So right now, it's just best to wait for the correction to be over as the market absorbs all the negative news that's been going on recently.
Okay, there's a question on can we get the presentation slide? Yes, you can. If you're interested in a copy of the presentation slides, you can just drop us an email at talk2globalmarkets@phillip.com.sg. Repeat, it's talk2globalmarkets@phillip.com.sg. Yep. So moving on to the next question. There's a question here on what is the best way to short the U.S. Treasuries?
Okay, I'll just give you some of my some recommendations, but you should ask your broker for much more information. Shorting, there are some ways. One way is you can actually buy the reverse ETF for the Treasuries. There are two that I have in mind. One is called the TBT, that is TBT, and TMW. These are the double and triple short ETFs for the Treasuries. The only drawback to this one is that for the TBT, you don't want to keep it for too long. You don't want to keep it for more than 3 months, in my opinion, because of the way the instrument is structured. But you can, but it's still a reasonable play. Another way is also to short interest rate sensitive companies. You can use CFDs to do so. So, for example, companies that will not do well in a high interest rate environment will be either over-levered companies that have a lot of debt, or companies like utilities, for example. The utility sector requires debt. So usually utilities do not do well in a high interest rate environment. Okay. Okay. Next question is, what is your opinion about technology sector, or especially NASDAQ? Well, okay. Sorry, for technology sector, we can go to, hold on. Okay, you actually notice one thing, that the technology sector is this figure here, S5I NFT, this info technology. So actually, the technology sector is performing on an improvement basis because it's in this region here. So that tells us essentially that it's one of the key sectors to look at, especially once the sell-off is over. So once again, this sell-off is widespread, it's to every sector and global. So we would wait for that to be over. And yes, I would probably recommend technology.
Hi, so hi. Okay, so we have a question on Iconics. The technicals show uptrend that is a correction. Do you see any further downside in price in the next few weeks? Will the negative news in retail affect it? Yes, there is okay, the thing results over the last few weeks, the earnings season. So yes, it might be affected by retail, but if you look at the longer trend, which for us is a 12-month holding periods, we are looking at a 30+% upsides, which is really substantial. Another thing is that if you look at the, if we use under one of DCF valuation, if we look at the G equals 2%, the floor will be around $32.30, which is a 70 cents downside, whereas upside is roughly $10. So we're looking at around 15 to 1 risk reward ratio, which I think is more than sufficient to compensate for the short-term uncertainty.
Hi, this is Kenneth. I also want to just add to what John Kai said about Iconics and the technicals. Now, the thing is, right, when Macy's and Walmart and the retail side, when they reported disappointing earnings as well as discouraging guidance. But I just want you to notice that if you look at the slide, right, you see that Iconics has a history of doing reasonably well. Even between the years of 2008, 2009, 10 and 11, these are the transition years from the financial crisis. You will see that they still manage to increase their revenue every year. So their strategy is pretty robust, the business model. Hence, but I can understand that they will be sold off as well, because when you have negative guidance from the same Macy's and all that, the whole sector gets sold down. So this is a case where, according to Yong Kai, that the company is actually robust and should be a candidate to buy, but you should wait for the negativity for the whole market to finish first before you buy it.
Okay, thank you. Any other questions? I think there's a short question here on the email, so I'll just repeat the email again. It's a talk to global markets with an S at the back at phillip.com.sg. Phillip is spelled with a double L. So in all, it's talk to global markets at phillip.com.sg. Yeah, so it's quite a number of questions on the slides. So I think what I'll do is those people who requested for the slides, have you on the question list. I will definitely send them out to you. And for those who want the slides, you can just drop us an email, as I mentioned earlier. Then we will send off the slides to you. Yep, so, okay, you're welcome, Johnson. Any other questions that we have? Yep, so there being no further questions, so coming to the end of our presentation, email, okay. Hanli, I will address your questions separately offline on the slides. Yep, well, many people requesting for the slides. Well done, guys. Okay, so no further questions. So coming to the end of our presentation, I would like to extend my thanks to our presenters, Kenneth and Yongkai. A quick mention, we will also be doing a posting of the recording of this webinar on our Global Markets website, so do keep a lookout for it. So finally, on behalf of Global Markets and Phillip Research, I would like to thank you for our audience for tuning in to this presentation. We look forward to bringing you more webinars in the future. Thank you and have a good day. Goodbye.